The first mistake many investors make is assuming that fundamentals always dictate a stock's movement. Experience has shown that this isn't always the case. Certain stocks, often referred to as cult stocks, can trade independently of their underlying business for extended periods. Unlike meme stocks, which rely on short-term hype, cult stocks develop a fiercely loyal shareholder base that allows them to operate in their own financial universe. One of the most prominent examples of this phenomenon is Tesla. Since the last election, Tesla's stock rally has been historic. In hindsight, many believe it was an obvious move. Elon Musk aligned himself closely with the election winner. Electric vehicles gained renewed momentum, and the promise of full self-driving technology came closer to reality. However, there were numerous reasons why some investors hesitated to buy in at the time. Skepticism about Musk's long-term relationship with the new administration, the slowing adoption of EVs in the US, and fierce competition in China all created a narrative that suggested Tesla was facing significant headwinds. There were also concerns about Musk's ongoing legal battles, particularly over his compensation package. Some believe that if he lost, he might walk away from Tesla entirely, redirecting his focus to another segment of his empire. Yet the reality played out quite differently. Wall Street's traditional analysts missed a key element. Tesla's stock wasn't just about financial metrics. The broader public, many of whom have little trust in Wall Street research, saw something else entirely. They recognized Musk's deep ties to the administration and understood that Tesla was now positioned as a crucial player in shaping the future of self-driving and AI technology. Tesla has amassed an unparalleled dataset of real-world driving miles, far surpassing competitors like Waymo. This data advantage is crucial in securing regulatory approvals and refining its autonomous technology. With an administration that appears willing to support Tesla's ambitions, there is speculation that the company could receive priority access to key infrastructure or regulatory advantages. Meanwhile, competitors like GM have pulled back from their own self-driving taxi initiatives, further solidifying Tesla's lead. Tesla is no longer simply an automaker. It is a technology company on wheels. This distinction allows it to be valued differently from legacy car manufacturers. Tesla's stock has surged nearly 90% this year, with most of that growth occurring after the election, as investors realized Musk's close political ties would provide the company with significant strategic advantages. When a CEO has this level of political influence, investors begin to envision unlimited possibilities. At that point, traditional valuation metrics, such as price-to-earnings ratios, become irrelevant. Investors will pay almost any price for the stock, regardless of its current earnings or cash flow, because they believe in its long-term dominance. This is the essence of a cult stock, where belief in the vision outweighs short-term financials. This phenomenon carries an important lesson. Conventional valuation models can sometimes be completely useless. Instead, investors must recognize when they are in a moment where fundamentals take a backseat to market sentiment and broader trends. Some stories are too compelling to ignore, and Tesla has become one of them. There is growing speculation that a federal proclamation could accelerate the national rollout of fully self-driving vehicles. Reports suggest that the administration is working with Musk to develop a strategy for autonomous transportation at a national scale. While skepticism remains about whether such a sweeping policy will materialize, the idea of an Elon premium persists. Tesla deserves a higher valuation because of Musk's ability to influence policymakers and shape the future of the industry. One of Musk's most significant victories has been the administration's decision to eliminate the $7,500 EV tax credit, a move that hurts legacy automakers far more than Tesla. While companies like GM and Ford have relied on these incentives to remain competitive, Tesla has already achieved profitability without them. The loss of these credits could severely impact Ford's EV strategy, particularly as it struggles with warranty and reliability concerns. Even if a nationwide self-driving mandate does not materialize, Tesla is still poised to benefit in other ways. Favorable regulatory environments, preferential treatment in municipal partnerships, and expansion opportunities along federal highways could all work in Tesla's favor. Most importantly, Tesla's positioning as a tech company, rather than a traditional automaker, allows it to maintain a valuation that far exceeds legacy manufacturers. There is an undeniable sense of regret among investors who missed Tesla's early growth. This has led to a wave of speculation in other EV startups like Rivian and Lucid. However, Tesla may be a unique case. There is no guarantee that a second Tesla will emerge, just as no company has ever truly replicated Amazon's dominance in e-commerce. Musk has fundamentally altered the conversation around EVs and autonomy. Even when Tesla reports weaker than expected earnings, Musk is able to shift the narrative toward future growth, keeping investors engaged. Tesla's recent robotaxi event was a pivotal moment. Musk introduced the Cybercab, a sleek, two-seater vehicle with no steering wheel or pedals, priced under $30,000. This price point is designed to make it feasible for small business owners to build their own Tesla ride-hailing fleets. In addition to the Cybercab, Tesla also unveiled the Robovan, a futuristic vehicle capable of carrying up to 20 passengers or transporting goods. However, the biggest surprise of the night was the latest version of Tesla's humanoid robot Optimus. These robots demonstrated remarkable dexterity, serving drinks and even engaging in conversations with attendees. Musk has stated that Optimus will be mass-produced and sold for around $20,000 to $30,000, capable of performing various tasks ranging from childcare to household chores. This represents an entirely new market opportunity for Tesla, further reinforcing its identity as a tech company rather than a simple car manufacturer. During the event, Musk also reiterated that Tesla's fully autonomous driver assistance system would launch in Texas and California next year. While skepticism remains about regulatory approvals, Musk's strategy of rolling out the technology in permissive jurisdictions before expanding nationwide could prove highly effective. Tesla's cost structure gives it a major competitive advantage over Waymo. The Cybercab is projected to cost only 20 cents per mile to operate, with customers paying between 30 and 40 cents per mile for rides. This is significantly cheaper than Waymo's system, which relies on expensive LiDAR technology. Additionally, the Robovan is expected to have operating costs as low as 5 to 10 cents per mile, making it a viable alternative for mass transit and cargo transport. Tesla has made significant investments in AI and neural networks to power its self-driving technology. Autonomous driving is ultimately an AI challenge, and Tesla is leading the way in developing robust, real-world AI systems. Even if full autonomy takes longer than expected, Tesla is already positioned as the dominant player in the space. Skeptics continue to question Tesla's valuation, pointing out that its market cap is now larger than GM and Ford combined. However, the stock market rewards growth, and Tesla offers more growth potential than its legacy competitors. Unlike Ford and GM, which struggle with declining revenues, Tesla continues to expand rapidly in key markets like China. The comparisons between Tesla and traditional automakers are becoming increasingly irrelevant. The stock market has historically rewarded companies with disruptive growth, just as it did when pharmaceutical giants overtook industrial manufacturers in the 1980s. Tesla's rapid expansion in China, where legacy automakers are struggling, further reinforces its dominant position. Despite its high valuation, Tesla remains an attractive investment due to its technological edge and market positioning. Traditional automakers are burdened with outdated business models and high production costs, while Tesla continues to innovate at a breakneck pace. Wall Street may not always understand Tesla's long-term strategy, but investors who recognize its potential are being rewarded. Musk has demonstrated time and again that he can pivot the company's narrative to maintain investor enthusiasm. Even when Tesla reports disappointing earnings, Musk shifts the focus to future technologies, keeping the stock moving upward. Betting against Tesla has proven to be a losing strategy for most investors. Tesla's relentless growth, AI leadership, and political influence make it a unique force in the stock market. While some may remain skeptical, the company's ability to dominate multiple industries, from electric vehicles to robotics and AI, suggests that its best days are still ahead.